Hello and welcome to World of Oil Derivatives, where we break down the latest news and analysis impacting the oil swaps market. I'm Greg Newman, the CEO of Onyx Capital Group. And my guest today is Ed Morse, Global Head of Commodities Research and Managing Director at Citigroup. A quick reminder before we get started, this podcast is available on YouTube if you'd prefer to watch it. So Ed, thanks very much for joining. Great to have you on.
Pleasure to be with you.
So Ed, you've been doing the rounds in the media lately, and I think it's been really interesting because you're basically the only real bear shouting loudly, at least. Just for people who are going to be listening, can we just start with what the view is from yourself and Citigroup on oil markets in particular?
So sure, we think the market is obviously very, very tight this winter. It's tight because inventories have gotten lower. They've gotten lower because OPEC Plus has done its job, and because U.S. short cycle oil really basically disappeared from the market, not totally disappeared, but had been growing rapidly and then started shrinking. And that plus some drop in Canadian production for a while has made the market tighter than people thought. Demand has been a little bit higher than people thought, partly because we had all figured that the COVID Omicron variant was going to see less mobility than has turned out to be the case. That's not just in the U.S. and Europe, but elsewhere in the world. It's also been the case that the winter has been colder than normal, so we're seeing higher demand for heating oil in some places. Germany certainly in November and December, the U.S. December, January, and into February, with the Northeast in particular being at almost record low levels of temperature for the season. So we've had a boost in demand, sometimes as high as 800 or 900,000 barrels a day in various weeks. That's winter. Then additionally, we've had fuel switching because natural gas prices have been so high. And we've had this unusual, first time in my recollection ever, situation in which natural gas is pricing higher than propane, higher than diesel. So we're having fuel switching taking place away from natural gas that, together with the increase in demand because of the temperatures, has added about 1 million barrels a day to demand for the heart of winter so far. And we've had a supply shock here and there, sometimes also over 1 million barrels a day, mostly led by Libya and Ecuador at times. But we're seeing freeze-offs in the U.S. because of winter, and those all add up to a lot of oil. So when we have inventories drawn down to a low level, obviously we get two things happening. One is a bidding up of gas oil in short supply, bidding up of oil, and we get volatility as the weather changes from day to day and week to week.
But it's in your forecast for the year from a Citigroup perspective.
Yes, we don't think the winter is going to last past the winter. And indeed, we see two things happening really that we don't find in reports of a lot of other people. The main difference is on the supply side, where we see an incredible response on the supply side to where the situation has been. That supply is going to come in the market, would have come in the market even if we didn't see this winter pull up in prices. So to round the number, we actually see a year on year 7 million barrel a day increase in oil supply or liquid supply this year. That comes in part from crude oil alone. It also comes from natural gas liquids. On top of that, there are two other areas of significant supply growth. One comes out of the move to more biofuels that we're seeing from refinery conversions to manufacturing centers of biofuels from waste products and other material. And we're also seeing higher refinery utilization, adding to refinery processing gains. And those four factors altogether, the biofuels, the refinery processing gains, the natural gas liquids, and the crude oil add up, in our judgment, to about 7 million barrels a day. And that's higher than anybody's notion of where oil demand is going to go. And there's a wide view on oil demand. We're not the highest by any stretch. We're not at the 4.2 million barrels a day that the OPEC Secretariat is, but we're up there at around 3.6 million a day.
And the actual numbers you were putting on this were kind of 75 around that number for the end of the year. Am I right in saying that?
No, actually, we're looking at 75 average for the year.
Yep.
we're
Okay.
looking at the inventory build increasing over the course of the year.
Hmm.
And as a result of that, we're seeing days of forward demand cover basically increasing. And with that, Brent falling to the mid $60 level, 65, and WTI to around $3 lower than that by the end of the year, average for Q4.
So I guess the question is when this comes in, because the supply and demand modeling that we've been heard talked about in the media and third party agencies were saying that even by Q1 on OPEC's own estimations, there were going to be inventory builds. Do you still think with the kind of shock of winter and everything you were saying before that this is still possible to get the price correction or at least the supply correction by the end of Q1?
I think we're going to get a supply correction by the end of Q1. The question is really how long winter lasts. So
Mm,
typically we have a really dramatic change in temperature around the world between February and March, and typically we get that drop in demand from that winter edginess coming fairly dramatically between February and March. February is by no means over. Last
mm,
February we had significant freeze-offs in the northern hemisphere, particularly in the U.S., also in Russia, um, but they're not likely to last into March. But what we don't know is whether the easing of the matter in March will move the quarter as a whole into a build, or whether the quarter will be in deficit. It looks to me at the moment that the fourth quarter will be in a deficit. The most recent EIA data show significant draws in the United States, the
mhm,
highest frequency data we have for the world as a whole. So, yeah, I think that it's going to be Q2 for sure, and
mhm.
whether it happens by before the end of Q1 is an open question.
So this is it. When people ask me the same thing, the problem is that we're talking really about financial contracts. If you're going to express your view, trading it as an investor, or just a trader. And the issue with that is, so if the question I just asked you is a little bit unfair because, Q1 supply and demand doesn't necessarily translate into Q1 equivalent contracts moving. So we're
Right,
already trading March, we're trading April in Brent.
right.
So of course, how you actually time this is going to be really interesting. But ultimately, I guess we first need to get some kind of correction in people's mindset because wherever you look, it's bullish, bullish, bullish. And actually, Javier Blas and Bloomberg actually did a sole article just on that point and included you as the front runner there, like being that you're the only one who's coming out and saying it's bearish, really. So surely that's a bit of a problem by itself. So we kind of need people to accept it first in order for them to unwind their positions, and whether or not that's confirmed at a later date is the issue with analyzing oil markets. But the question I had was people's points before we kind of got the winter crunch of why we should have a bullish run is this argument of spare capacity. And I'm really keen to get you on just to ask this specific point. Why do so many people talk about spare capacity as if we're not in the middle of a coordinated cut? Because I remember you mentioned on Bloomberg, it's misleading when people say this because OPEC, of course they can. Do you agree with what I'm saying?
I agree with what you're saying in actually two different ways. So, one
Mm,
is to take the standard definition of what is spare capacity. So, that
mm,
standard definition is oil that can be brought into the market within a 90-day period of time and be
mm,
sustained for a good 6 months, a half a year or longer. And the problem with that definition is not that we can't measure spare capacity. We actually think there's around 3.5 million barrels a day of spare capacity in the market today, not as much as there was last or July of 2020 when the OPEC plus countries cut 10 million barrels a day of supply, and when the U.S. was on a downhill in terms of production, and Canada was on a downhill in terms of production. But I think we do have another thing to bear in mind, and that is we do have short cycle oil in place, and we do have an ability to estimate what oil that is not now being produced could be produced within that period of time. So whether you look at it in the 3.5 or so million barrels of real, truly spare capacity now, or what's unfolding during the year, makes a little bit of a difference. What's unfolding during the year is a massive increase in production capacity and production. That
mm,
production capacity is being added, in particular in the United States. It's probably among those who have capacity to add the number one, where we're seeing a year on year capacity increase of no less than 1.3 million barrels a day, 2022 versus 21. And from now to the end of the year, if the EIA is right that we're producing 11.4, so now we're looking at 13 million barrels a day production by the end of the year. And that would be a good 1.6 million barrels a day of an increase on crude oil. The year on year number would be lower than that. If we look at Russia, we have to bear in mind that Russian companies have increased their capital spending to record levels. They had cut back significantly after the cuts in production in 2020 and the additions back in 2021. But they're now, with a record flow of capital into the sector, they're capable of adding 1.3 million barrels a day to the system between the beginning and the end of the year. And that comes in part from new greenfield production, but it also comes in part from the reopening of wells in brownfield production that had been closed because they were mandated to be closed, and the tax system indicated that companies would, with a choice of closing production here or opening production there, they had a tax advantage in opening greenfield production and shutting the brownfield. But enhanced recovery, of which they're specialists, is going to come into play, and that's not necessarily spare capacity today. We think of Russian spare capacity in the 300 to 500,000 barrel a day range with the traditional definition. But if you're looking at where capital is flowing, you get a very different answer by the end of the year.
I got to say, there's so many things I want to go into. I know we don't have that much time, but it's, everything you said, really interesting. But one of the first things I was thinking was US production. Actually, before we started this, we just had a brief chat about the media only talking kind of one thing. But actually, I've got to say, if you're looking objectively at what's been written, it's not like the media has been hiding this, what you're talking about, the light cycle oil really ramping up. I mean, it was only last week the ConocoPhillips CEO was saying he's worried about it. You know, everyone should be worried. This is coming in full force.
Yeah.
And I remember back in November, Exxon, Chevron, BP, they made it very clear they're going to be ramping up production. So it's almost like, I guess my question to you is, given that it is there, all the data is there, do you think the markets are effectively in denial, and the people with the analytical community that have an influence over the audience of oil are just kind of ignoring it? Is that your view?
I think they're ignoring it, and I agree with you. I think they're ignoring what they're saying themselves in the reporting that they're doing. And you picked on the majors, and we have one of them that you talked about saying, you know, we got to prepare for the new world of moving away from fossil fuels. Yet if you look at that company's projections over the medium term and include what they're shaving off of their own balance sheet, they're going to be growing production in as between their current assets and where they're growing. If you look at the two Permian producers that you spoke of, Chevron and Exxon, they have a lot of plans in place, and those plans are basically to double their current production by 2025.
Wow.
And some of them, well, Exxon in particular, has a natural gas project that is going to be producing LNG. They could produce natural gas associated with production. In the Permian, they have a target in 1 million barrels a day of oil production by 24-25. Which would facilitate the 2.5 BCF a day of natural gas they need to fulfill their LNG progress plans.
This is the second part of what I wanted to ask. You know, you've got the articles are out there explaining that US production's coming in force. CEOs, companies saying it. You've got the IEA saying back in Q4 that there's going to a hell of a lot of US production to come online. EIA are now saying in their latest monthly report it's going to come up. So, I mean, I don't think anyone can say that with the lack of a production cut from OPEC, we are oversupplied. I think with the US where they are and where they're going, you have to come to that conclusion, I think. But I guess what I wanted to ask is, you know, we seem to have forgotten that the oil markets were led in the last few years about market share. You know, OPEC and Russia reacted to market share, and Pavel Sorokin, you know, when he justified their actions that led to the price war, he was saying, 45 to $55 per barrel on Brent is actually kind of fair for us. We can invest in that. That's all okay. So, we see this more of an issue of winding down and winding up is a logistical issue, and it's a constraint. We'd rather not do it and average out on the long run. So to suddenly be in a coordinated cut and to have all this US production definitely coming online, and probably hedged or starting to be hedged now, when do we start talking about market share again? Does it become about that, and do OPEC suddenly flip the switch again, or what do you think is going to happen in that respect?
I think we start talking about market share a little bit later on when
Mm,
prices start rolling off. But there's no doubt if you look at the statements made by the Russian companies, and I think it's true of all five of the big ones, that market share is very much in their mind, as it was in the winter of 2019, 2020, which was the last time they were spending this much capital on growing production. They didn't anticipate the existential threat that emerged when the Saudis and the Russians went into their own little market share battle just at the height of the pandemic hitting the world. Uh, but yeah, market share is what they're after
mm,
because they've seen the consequences of losing market share. I think they are maybe a little bit different from one another on their views of how much the U.S. is going to come back. We do,
mm,
after all, have prominent CEOs of shale producing companies that say, the maximum longer term level of growth of U.S. shale is going to be 300,000 or 400,000 barrels a day. I'm surprised that we see in the news, and we've seen in some pretty prominent newspapers in the last week, articles on how the fracking boom is over, and how they say this when, objectively, I think with, the a sliver of the Permian Basin is like the Ghawar field in Saudi Arabia. Companies that are positioned there have 70 years worth of growth. And if you think about this from a rational perspective of monetizing your reserve base, you can more or less rationally say that sometime between, I don't know, 2030 and 2050, we're going to see a significant drop in demand
mm,
because of actions being taken to meet net zero assumed obligations by governments.
mm.
And sometimes, the value of oil in the ground is less valuable than the value of oil that you might be producing.
As you said, the Permian's already at a record, right? That's what it's signaling to be in February. So, yeah, absolutely. I mean, more the trading side, we like to look at markets very much with the trader psychology and positioning angle. That's where our edge is. That's where our data is, and the markets are becoming more and more financialized, so they can be driven by these types of things. So I think, in a way, I'm answering my own question about why people are in denial because they want it to go up, right? They're bullish, but I think another thing I think is going to be really key, and I wanted to see if you had any thoughts or agreed, was that in order for this US production led oversupply, is essentially what we're saying. Um, Before it can really transpire into the futures market, it has to be the sellers of that oil have to come in. In other words, the hedgers need to come in. And I think objectively, you can say that there wasn't very aggressive hedging from producers last year. We've looked at the statistics, and the producer versus end user kind of long to short on Brent futures, the ratio was about 0.45 to zero point 0.5 in typical markets like 2016 to 2019 when the price was low. In 2020, of course, people stopped hedging and it got back to like zero point 0.8. Now we're about 0.67 ish, so we can still go quite a bit further. So there's clearly still people not really hedging despite exactly what we're saying. So now the CEOs are coming out on record in the shale side. Do you A, think there has actually been a lack of hedging, or there is there a different mindset this year? And yeah, do you think producers are changing their mindsets?
Well, I think there is a different mindset this year than there was in, let's say, 2018. But I also remember the mindset in 2014. So we had 2014 with a very edgy market. We had prices spiking with Russia's taking Crimea and some other events. And we had a highly backwardated market until late spring, early summer. And there were two things at work that convinced people not to hedge at the time among the publicly traded companies. One was, hey, this market is so backwardated, how can you really sensibly hedge it? And the other was that uh, prices we're still pretty solid. What's wrong with where prices are? But by the end of the year, and certainly by September, we saw prices going down significantly, and we saw a rush to hedge by the time we got into the winter of that year.
Mm.
So
Mm.
I think about what's happening now with the large publicly traded companies is a mindset very similar to what we saw in 2014. 2014, by the way, was the breakout year. It was the year that U.S. was allowed to start exporting oil again. It was a year in which the Atlantic Basin became self-sufficient for the first time in modern history, and that also bred a little bit of complacency. We saw a pullback on this with the decline in U.S. production, and now, if we're right that we'll have a new record level of production by the end of the year or early in 2023, I think that mindset will change again. So,
Mm.
uh,
But as you say, it's always a rush to it, and I think
yeah,
at the end of November last year, it's probably what we saw as well, right? It was such an aggressive move because you get one abrupt change in mindsets, b the unwinding of a lot of speculative longs, and then you get the hedges rushing in to get it done. So it's no
yeah.
wonder it was such a cataclysmic sell-off. And I've got to say, we hold the same view, and it's refreshing to hear an analyst. Well, you're very experienced, so I guess it's not surprising, but as in it's refreshing to hear that you don't just think oil's going to go down, it's 65. Because oil, I mean, you just have to look at the historical pricing. When you have these supply shifts, it's never 10 barrels, $10 per barrel. It's, a pretty monumental move. So I couldn't agree more. The only thing I'd add to this, and this is hugely speculative, but again, on the trading side, I refuse to believe the oil traders and the majors, the kind of influential futures players, I refuse to believe they don't see the same thing we're saying. But there is tightness in the prompt. So with new money this year, get long, see the prices go high, especially in the swaps, price them out. That makes a lot of sense. But I would be shocked if they're not building up short positions at the moment. And when I had a look just before we got on, the December 60 strike puts for Brent are, $4 per barrel, and the volatility is clearly baked into that. But also, I think the speculation and the call put skew is the most bearish it's been in quite some time, which shows you, I think people are starting to think, yeah, there's hedging going to come in, there's all the supply, it's a great level, it could be a really great ride down. I don't know if you agree with that. It wasn't really a question there, but I just wanted to add that.
No,
Not sure.
I actually do agree with you, and certainly, I can't say this is true of all of the uh, typical investors that we talk to, but certainly we have seen some of them uh, moving toward taking a short position.
So just final question. You've made these market calls over the years. It's really interesting looking back at what you've said in the press and your general career. When you were calling for 2008 and 2014 sell-offs, like you said, it feels a little bit like 2014. Why? What does it take to be a contrarian in that situation? Because you are so singled out, and it's difficult to be that person. So do you find that difficult, or is it just something you're comfortable with, or you just stick to the data, or how do you feel about it?
Well, what we tried to do in 2008 is a little bit different from today. So I was working not at the place I'm currently working, but a different place, and um, we had certain matrices that we were using to kind of look at where pricing ought to be, particularly deferred pricing, where there's an anchor in the market. The anchor
Mm,
had actually been there at $21 Brent, 20 to $21 WTI from 1987, when we first started having a decent amount of liquidity in the forward curve,
mm,
through 2022. And one of the striking things about that is that there was basic stability in the cost structure of the industry. Finding and development costs were going down a little bit. There was a remnant of cost deflation, but they were between $6 and $7 a barrel. So, on average, uh, finding and development costs had kind of slipped a little, but then to the $6 a barrel level. But then all of a sudden there was a supply shock, and that supply shock people thought was induced by Chinese demand growing unexpectedly. It really was induced by a real loss of spare capacity and current capacity. So we had four countries, Venezuela being one of the biggest, Nigeria, Iran, and Iraq, which were all from the perspective of 1998 planning on increasing their production. In fact, if you took those four countries together, their stated goals for a decade level later were 10 million barrels a day higher. When you got 5 years later, 2003, they were producing half the amount they were producing in 1998. The industry had felt that they were going to continue to invest, so the industry was lax in capital spending, and it had to catch up. But prices not only went up in the front, the deferred prices went up as well. When oil hit $147 Brent in July 2008, the back end was well above 100. So there was instability there. But what we had tried to do is look at cost data on a monthly basis. So we could not wait to the end of the year and wait for all 10Ks to be filed and see what the average finding and development costs in the world were. We wanted to see it in as real time as we could. So we developed a methodology to do that. And what we perceived in the period starting in February 2008 through June, July, was that while prices were going up continuously almost, and while I would say the liquidity in the market in what you do was skyrocketing, what we saw was that the cost structure had really tapered off. It had come to a point of ending cost inflation because of new technologies and the like. So part of calling it a bubble at that time, as we did, was based on the confidence we got on where the cost structure was going. I will say I wasn't as confident in looking at it as I am today, or as my team is today, largely because we didn't have the experience of looking at alternative sets of data. Now we have the experience of looking at cost data on a monthly basis. Now we have the experience of looking at days of forward demand covered by inventories, where prices have been at various levels of forward cover of inventories. And if we see inventories growing in days of forward cover with some confidence, we can think with some confidence about what the price level would be that would match that level of inventory build.
It sounds like you just have a ruthless approach to data analysis and you stick to it despite the noise and the media. So that's, I guess, why you're able to just come out and say it as it is and you're not afraid. But, not everyone can do that. In fact, most people don't. And they have to go through the herd. And going back to the beginning of this conversation, the analytical community kind of needs to talk up what the market wants to hear to some degree. So to come out and say it and put a flag in the sand and say, this is what I think, and it's very different. Clearly don't have any problem with that. So I really applaud you on that. But Ed, I don't want to take any more of your time. Thanks so much, honestly, for joining. That was really, really great. And that brings us to the end of the episode.
And thanks for inviting me to be with you today. Thanks.
Thanks again to my great guest there. Just a reminder from us that you can follow us on social media by searching Flux Liquidity Hub on Instagram and Flux-Live on LinkedIn. That's goodbye from us now. See you next week.